Welcome to the Property Trio. It brings me great pleasure to be in the host seat for this week's episode, and we've got an exciting listener question. But before we go into that, we were just having a little chat off air about doing a live Property Trio recording. Dave was having a chuckle. Not sure how to take the temperature on that one. What do you guys think?
Yeah, well, let us know. Send a message, and we're not going to do it unless people think it's interesting and they can come to a place and spend an hour of their evening and maybe have a glass of something lovely, shoot some questions at us. So I think it would be great fun. I've done one or two before, and great opportunity to interact with the audience. But we want to hear from the listeners. If you're keen, and your location is important as well. This is there is a big Melbourne bias to this show by virtue of you two guys, but I'll go anywhere.
Well, that just ramped it up a level for me, because I thought you were talking about a Facebook Live
we are
recording. But you're talking about actually going somewhere and getting people into a room with us as well, which
either or
sounds good.
Yeah, I mean, Facebook Live is an easier way to do it, but an in-person thing would be great. It'd be great to meet some of the people that chuck questions at us and some of the listeners, and good to receive some hate mail in person.
Well, if we get a minimum of, what will we say, 5 people who want to have a fireside chat and a wine with us, we'll do it.
That'll do, including us.
Oh, so funny. All right, we just need 2 takers. On that note, let's move into today's show. For today's episode, we have a number of fantastic questions from Emma. Emma's asking for advice on making her first investment post the family home acquisition, and it's regarding timing and whether to invest in shares or property first. So Emma writes to us, I'm in my early 30s and my husband late 30s. We have 2 young children. We recently made our forever home purchase in Seaholme around a year ago, but not many people know where this is. Cate will, 2 million plus. I certainly do know where Seaholme is, Emma. I love it. It's a sleepy little pocket around the corner from Williamstown. So if you follow the coast, just before you hit Altona, you've got Seaholme. It does have a train station and only a couple of little shops, but it's one of my favourite little hidden pockets. Emma's mortgage is approximately $880,000, mostly offset. I love the idea of all going to plan. We want to stay here forever. No plans to upgrade. Our combined income is just over $500,000 per year gross. I work part-time and I'll increase my income when the kids go to school. We own an inner city apartment that's rented at $900 a week, and we'll sell that when the kids are out of childcare. We have cash savings that could enable a deposit on an investment property. My husband has purchased multiple properties in the past, mostly smaller interstate properties, and our PPOR, principal place of residence, is my first property purchase. I've always been into shares, and I've done quite well for us investing pre the home purchase. My default thinking has been 100% share investment after buying our home. However, perhaps an investment property is the way to go first. And my query is, timing. Do I do it now or do I wait? Lots and lots of questions here. Dave, I'm going to kick off with you. Can you explain the importance of aligning investment timing with one's personal financial stability? And given our listeners' strong financial position, do you think now is a good time for them to invest?
Yeah, look, I thought pick this listener question for my episode today of Emma's, and we do have a bit of a bank of them. Just shout out to anyone who has sent us in listener questions. We're trying to get around to everyone. Because it's such an interesting situation. Emma covers a lot of things that go into, I guess, property planning. Firstly, she's in a great position because she's got the big rock in the jar. They're happy with, they've got their long-term home, so they can just focus on investing now. So aligning investment timing with one's personal financial stability is crucial for several reasons. So firstly, your financial stability determines your ability to manage and sustain an investment, especially in volatile times. Now, Emma and her husband's situation is quite strong. Their personal finances are in order, and that means they have a solid savings buffer, and that is a really important part of your risk management strategy. They've also got management debt levels. She commented on having a fair chunk of money in offset. They've got a strong income, and also, so it sounds like they've got surplus cash flow. So you want to have all those things in place before you, I guess, take the next step in investing. So that allows you to be in a stronger position to absorb any unexpected costs or economic downturns that might affect your investment or your own personal circumstances. So, given Emma's strong financial position, now it sounds like now's a good time to invest rather than waiting. Emma and her husband have, as I've touched on, a significant amount in their offset account. So I guess, like, just to provide some examples of some numbers of why I would suggest, if you are in the position to do so now, move forward with it. Basically, if they put $1 million into the property market or shares today, in 10 years' time, it'll be worth 1.6 million. In 20 years' time, 2.6. 30 years' time, 4.3 million. Now, what this does, which we've highlighted in previous episodes, is it shows the benefit of time and compound growth. But let's say Emma decides, for whatever reason, there's no perfect time to start investing, but it does sound like Emma's in a position to do so. But let's say she held off 5 years, and let's say that's how long it would take to fully, completely pay off the home loan, and then invested that $1 million. That would mean, and let's say she had a 30-year timeline, that would mean if she invested today, the property would be worth 4.3, but if she waited another 5 years, in 30 years' time, the property would be about worth about 3.3 million. So that's a difference of almost $1 million if she decided to wait 5 more years. So what obviously I'm highlighting there is that time is the most crucial element in when it comes to your financial returns. Even a modest annual growth rate can result in substantial increases in value if the investment period is long enough. And so, again, this is why starting early is so advantageous.
Yeah, I completely agree. I've always maintained that time is the critical ingredient. Now, Dave, Emma's also asked for our thoughts on shares versus property and what would be a good diversification mix. And right now, I would love to have just beamed Pete Kalizos into the studio, because he actually co-authored a book about property versus shares, but we'll have to nut it out ourselves, and I know that you're no stranger to shares. Emma has a background in shares and she's done well. So let's start off with diversification first, and how should that be factored in to your overall investment strategy?
Yeah, look, I mean, my general belief is I have no preference in property over shares or vice versa, despite having been in the property game for a long period of time. I definitely believe in diversification because it helps spread your risk. And by diversifying, you're not putting all your eggs in one basket. So getting some share investment in addition to property, I think, is a great idea for everyone. Something that people can forget to think about within their overall investment strategy is sometimes they won't be thinking about the value of the home in that picture, but often they won't think about the exposure they will have to shares through their superannuation. And these are two of the more significant assets you own. Often the home is the largest and most expensive asset, and it can make people feel like they're a bit overweight in property at times, particularly if they've then got an investment property as well. But as I said, superannuation is typically mostly invested in non-property assets, including shares. So making sure you have this comprehensive view helps with understanding your true asset allocation and forming the basis of making informed decisions. I think sometimes thinking of a 50-50, it needs to be 50-50 split, which I have heard before from some particularly financial planners state. I think that oversimplifies things.
Me too.
Even if you look at the nation's weighting of investments, we have 10.7 trillion, give or take, in residential property, but there is only 2.67 trillion on shares, the ASX listed. Yep. So, that's sort of like about 75-25 split there. Now, obviously, there's international shares, but then there's also international property. So I think, like the point is that I believe in diversification, but you've got to find the balance that's right for you.
I want to add to this because, in the past, I was guilty of not diversifying enough. And I'm now a share investor, not a share trader, as well as a property investor. And I remember, years ago, our accountant said, Kate, I need to talk to you about diversification. And I said, Alan, it's cool. I'm in quite a few states and I've got commercial and resi. He's like, no, you're not listening to me. But what I do want to say is the big difference between property and shares when it comes to investing, in my opinion, is about leveraging. And property is a young
That's coming
investor's
up.
game. Yeah, and I note that, and I think it's really important that we talk about, the vehicles to get to your wealth creation and the journey that you take and the stage in life that you're doing. And I know you'll touch on it, but I think to your point, Dave, it's much more critical to understand all of that than to just have a broad metric like 50-50. I agree with you that it's way too simplified.
Yeah, and
Now,
as you alluded to, which we'll come to in a bit more depth later on, leveraging plays a part, stage of life plays a part, doesn't it? So there's different
yeah,
elements to that.
absolutely. Now, Mike, you've been quiet in the corner there. I'm bringing you out. How does a person's age factor into an investment strategy?
Well, it could be as simple as how big is their time horizon, right? Because if you're in your 50s and you want to retire, you've got a limited amount of years where you can get the capital growth, we can get that compounding effect. So ideally, people should invest as a fetus, right? But it's not possible. You need to get to a point where you have enough capital to do it. And then, all the things that you're talking about, leverage is important, diversification is important, but when you're younger, you might be less diversified because you've got a bigger risk appetite because you've got so much time, and you can be a little bit aggressive. You go to a financial planner and you fill out the, what's your risk profile, and when you're younger, they would be more likely to accept that you have that higher risk profile. But it really just comes down to how much time have you got to achieve a certain outcome. And if you're starting out early and you have a reasonable income, you might go to capital growth style properties rather than focusing on yield. If you're, approaching retirement, the assets that you select might be a little bit more yield focused. Or if you already have a portfolio, you might be looking at commercial. So it just really goes down to how much time have you got to play with, what sort of assets have you got, and what is your goal. But timing and time in the market is important, as Dave shared in his case study.
Yeah, very true. So back to leveraging, Dave. What role does leverage play in property investment, and how does it compare to investing in shares?
Yeah, so look, this is sort of the example that you often can use that highlights the power of property, really, because banks are happy with it as security, and it gives you the ability to get more money into the investment world with property, because you can obviously borrow more than you can with shares. So I'll just give an example that if Emma or anyone has $200,000 in cash to put towards an investment. So let's say you purchase an investment property for $1 million, using your 200,000, and you borrow the remaining 800,000 at an 80% loan to value ratio, which you can obviously do with property. Well, and then let's say you're getting 5% capital growth. In 30 years' time, that property will be worth 4.3 million, and your rental return, let's assume it's a conservative, say 3% yield, will be 129,000 of rent per annum. Now, over those 30 years, your total rental income will actually be, you will have earned $2 million in rent, and you will have a property that's grown in value by 3.3 million. So that's a gross return of 5.4 million over 30 years, mostly because of the power of leverage. Now, let's say your interest rate, going interest rate, give or take, at the moment might be, we've used 6.7% as an average interest rate. That might even be too high. Who knows over those 30 years? So let's say you've paid $1 million in interest. So your return then comes down to about 4.3 million. And let's say that's before holding costs. Let's just say your holding costs conservatively were another $1 million over those 30 years, your return's still $3.3 million. But if you just invested that straight with your own cash, let's say 200,000 into shares and same return, 5%, your shares have grown at 5% per annum, then you've got a 3% dividend per annum on those shares. After 30 years, your value of those shares will only be $864,000. So not even cracked $1 million, and your average dividend will only be $25,000. So ultimately, the difference in financial return is around $3 million, and that's because you're able to leverage and get into a much more higher valued asset from the start and let time do its thing. And that really, is sort of getting to some of the points you've both made, is why when you're younger, it can make more sense to leverage up and then get into property, which is you're able to leverage against in a way that you can't with other assets.
Yeah, without a doubt. And obviously, the price that you pay for that is interest and, a little bit of healthy stress along the way. If you get things right, you don't want unhealthy stress. And of course, the impact that it has on other future financial decisions, because you've got borrowing capacity constraints when you're carrying other debt. But I think that's just such a powerful illustration. Mike, given the leverage advantage that property offers, why might someone still choose to invest in shares over property?
Well, I think, ignoring the leverage, shares, you can be much more defensive with them. And there's a real broad spectrum of the investing that you can do in shares. And I suppose that's true to some degree with property as well. But you can look at assets that are going to be pretty robust and minimize that that potential pain. Leverage just really kind of magnifies outcomes, right? And that can be both positive and negative. So if you're risk adverse, then leverage does certainly expose you into a little bit of pain. But the risk just comes with that associated debt on the property. So you've got to be someone that's willing to take more risk, and it comes down to your profile, your personal preferences, and really kind of what you have already. So if you have property assets, then you might kind of go, all right, well, I feel like I've got a bit of exposure. I want to be a little bit more defensive. So you've just got to choose a vehicle that suits your goals and has a risk profile that you're comfortable with.
Yeah, nicely said. Now, Dave, you can also leverage property to invest in shares. What are the pros and cons here?
Yeah, so look, I mean, you can borrow against the property to invest in shares. So that can allow you to access more funds, but it does use up the equity in your property, which then can't be used to invest further in property. So you certainly want to be weighing up, do you have further plans to invest in property? Or, you might have plans to do some renovations on the home. So you've just got to understand, okay, well, if you're chewing up that equity, you can't use it for something else, or do you need to be reserving that for other investments that you might have on the cards down the track? So in other words, it isn't creating more equity to invest in. You can, it's worth sharing that you can leverage shares against what's called a margin loan. However, these have lower loan to value ratios, so you can't borrow up to 80 or even, as high as 90 or 95% against them. They're usually around 60 to 70% of the share value. Also, because shares aren't considered as safer security, the interest rates are higher on margin loans. And then also you have the risk of margin calls. So because shares are valued and change value every day, if their value drops by a certain percentage, you can be called upon to have to inject cash, whether you have it available or not, to then reduce the loan to value ratio that you effectively have on that margin loan, which obviously doesn't happen with property unless you are actually doing a revaluation. And obviously you would need the valuation to be less than it was in the past to then have to come up with cash in that example. So, margin loans just aren't the same, aren't as beneficial as loans against residential property for those various reasons. So obviously each method has its risks and benefits, and it's crucial to understand these before making the decision. So there are some of the considerations.
You got to have
It's quite
that.
a vulnerable setup, isn't it, Dave? Imagine if a margin loan was called in, that would signify that you've lost a lot of value in your shares, and so that impacts your capital if you sell. But then the lender is also asking you to make an immediate payment. You'd be watching your nest egg unravel pretty quickly when that happens.
Yeah, you'd be pretty nervous, wouldn't you? And it does provide that the propensity to be watching the share market more closely on a daily basis. So it's not for the faint-hearted, whereas property, you can sort of, you're not checking the value of your property every day.
You got to have that money available too, right? They're not not going to be terribly patient if the loan to value ratio goes into sort of negative territory. And you don't for most people, you don't want to be looking at your share price on a daily basis, because it takes discipline to hold a position and you can be really nervous. We do a market update every month, right? And if you made decisions just based on what happened in that month compared to the previous, you'd be all over the place. But you zoom out on property, you see those graphs over 60 years, those things that look like massive booms, massive crashes, all kind of flatten out in a lovely little way. And personally, like if I was checking every day, I'd be getting twitchy. I'd be wanting, I'll sell down a little bit here. And with property, you could buy something and then the market drops 7% from a peak to trough. There's no real evidence go back as far as there are records that it drops more than about 9%, right? But the bank's not going to look at that and go, we need more money from you. Obviously, if you sell that asset, there could be a deficit that they're in for, but you just kind of hold it and ride it out. It's a very different sort of thing.
Yeah,
it's a really good point. If you look over the history of share prices, they tend to fluctuate much more than property. And so that is another layer of risk when it comes to investing in shares, that you're more likely to have larger falls. You also can get much larger rises as well. So it's not to say that shares can't make as much or if not more money than property, but, you have to be willing to ride that journey. And we know from behavioral economics that people tend to sell at the worst possible times when they shouldn't, and ends up actually costing them more over the long run if they are a bit nervous when it comes to the changes in the value of their assets.
Yeah. Dave, for someone who's ambivalent and not particularly swayed towards either property or shares, what would you recommend as a balanced investment strategy?
Well, overall, I believe, as I said, investing in both property and shares. And if you find yourself ambivalent between the two, as I largely am, I would suggest initially focusing on securing your home and acquiring 1 to 3 investment properties as quickly as you possibly can. We've sort of covered, I think, the benefit of time, the benefit of leverage, and those really add up for property because of that ability to borrow. Then after this, or potentially ideally simultaneously, it can be a good time to start focusing to shares, but ideally initially by maximising your superannuation contributions given the friendly tax environment. Always retaining the ability to continue paying down any existing debt, especially focusing on the home loan if it's not yet fully paid off. And a strategic approach might be to time your share investments. For example, you might say, look, I'm going to start investing in shares once I'm able to comfortably contribute my maximum to super, I'm paying down debt on my home loan, and once I've got passive income from my rental properties, then I'll start putting extra into shares outside of my super. So that might be, a way to set a goal as well. Once your properties have become positively geared, so a balanced strategy allows you to leverage the benefits of both asset classes, and importantly, inside and outside of super, while maintaining financial stability.
I think people sort of forget about their super to some degree. I mean, they know they have it, obviously, but they forget, unless it's a self-managed super fund, how much exposure it does actually have to shares. And when they think about their net worth, they might kind of forget that is an allocation of their investment, of their cash, their net worth, and that you could actually find you're disproportionately on the share side of things. But for me, it also comes down to where you are in your investment horizon. If you're right at the beginning, the leverage power that you get from property is so much better than shares. Of course, you can borrow money to invest in shares, but it's not the same, as you mentioned. And I've spoken to someone before who said, like, I would invest in kebabs if it got me where I needed to be. Like, the property versus shares versus kebabs, it's all kind of academic. It's just that property gives me that ability to leverage into the investment. And if the property's going up in value, you're getting the upside for, less of a chunk of ownerships. And that's what the difference is for me. And as you get later on in time, you want to probably get a little bit more diversification and be a little bit more defensive, because it's one thing to grow and maximize, it's another thing to protect. And we should all consider protection as part of the piece as well.
Yeah, 100%. And then, transition into, as you said, those later years, the more of a return in terms of the yield and the cash flow you're receiving versus the asset growth.
Well, Cate, Emma's, she's got a lot to work with. And I should say, Dave, you mentioned that, she's in a good position. I think she's probably in the top 10% of positions and what she's able to do. She's asked Cate where to invest in Melbourne's inner west. Can you share some insights on where you think the best spots are and some of the returns and crystal ball, all these sorts of things that people love to be on record for?
Yeah, Anne-Marie wanted to help me out with some notes, and interesting. This particular question, I don't need notes. I could answer off the cuff because Melbourne's my market, and it was ChatGPT that came up with the inner west as an option. So we wanted to just profile 3 different price points, and let me just define this. Best investment is so subjective because it absolutely depends on everyone's own financial position and where their stage in life is, as Dave's always said. So the first question I ask people when they say, I've got all of this money, what's the best investment? I talk about their cash flow. How much can you apportion to holding this property when you've got your rent coming in and all of your outgoings going out? What do you want to be spending each month? And then we can calculate it. And even if they have a greater capacity, they have to leave room for the next one as well. So it's all about metering out your property purchases in the right way so that you're not just hitting the rev limiter with the first one. But let's assume that we're going for capital growth. And let's assume Emma's really comfortable to spend $1.5 million. I would be targeting a character home if I could. And so that is where the inner west comes into play. But also there's pockets in the inner north that could deliver this as well. And whether it's a really smart 2-bedroom period Victorian, single front or terrace, or whether we covered this only a few weeks ago, do we buy a 2-bedder or a 3-bedder? If you're wanting to get a larger, double fronted home, so one with the hallway down the middle, you could certainly target areas like Yarraville said, and Newport, Kingsville, and you'd be able to get something there. It won't be in the top quartile, but it will be a nice property. We can also go north into, pockets of Brunswick and certainly into Coburg. We could look at Pascoe Vale South. We could even look at really amazing parts of Reservoir. You get some good options in Preston. So $1.5 million goes a long way. If we're looking east and southeast, you're obviously going a fair bit further and you're not necessarily getting a period house. Then let's talk about $1 million. And usually at the $1 million mark, not everyone has really strong cash flows and can sustain a negative cash flow property like a higher purchaser could. So at $1 million, we might be talking about townhouses where you get, that happy blend. And the ideal townhouse, as I've always said, is one on its own title, one little pocket of land in a great spot with high amenity. But we could certainly target parts of Footscray, Newport, Kensington, Flemington. In fact, we could move around Melbourne with $1 million if we're targeting townhouses. But when we're talking about houses, it's pretty much the last bastion. The inner ring is going to be really hard. You might get lucky in Footscray, but you'll be compromising. You'll be getting something on smaller land, or you'll be getting something that's not quite as renovated. Occasionally we get a gem, but $1 million is hard for a period property. We do have a jump into Sunshine and Albion when we've got $1 million to spend as well if we're looking for a larger home. Now, when we're talking about $500,000, I would really prefer to try and get something with some land on title if I could, which means we've got to circle in on villa units, and that takes you a little bit further out. But I've also gone on the record and said that there are some great apartments out there in boutique blocks that you can purchase for $500,000 around the place. Obviously, you're not getting outperformance capital growth, but then you're spending a fair bit less as well. But you really should be looking at something around that 3.5% to 4% yield if you're targeting an apartment at this price point, ideally 4%. So there's some of my thoughts. And obviously this isn't financial advice, but it just goes to serve that people have different cash flow scenarios as well as budgets. Budget isn't the only question to focus on. Now, Mike, given Emma lives in Melbourne, the Melbourne property market has been relatively stagnant recently for a long time. Could you share your insights on whether this presents a unique buying opportunity for our listener?
Yeah, well, we know from the data the last quarter we're down, 0.6% and up only 1.3% annually. So it's in the doldrums compared to places like Perth, Brisbane, and Adelaide. And there's a lot to be optimistic about with Melbourne. It's still getting, it's a great share of international arrivals. It's not suffering from losses of interstate migration, perhaps like it was during the pandemic. And it's often rated as, one of the most livable cities. And that median house price that was always kind of sitting in sort of second, third position after Sydney and Canberra, it's sort of drifting a little bit more to the middle of the pack, with Brisbane overtaking it. Obviously, there's some segmentation issues there. The thing that probably worries me most about Melbourne is the state of debt within Victoria, and we're seeing all sorts of fruity housing policies, in and around land tax to try and recoup some of that. But I think the fundamentals are strong, and when you can look at the past performance, you can look at where it is now, you can look at the difference between the Melbourne median and the Sydney versus the Brisbane. But from a buying point of view, I think it's easier to look at things like listings, because that speaks to kind of the competition, and you want to be transacting when there's a lack of competition. And some of these housing policies have probably disproportionately scared people away, because everyone kind of reacts quite strongly to new taxes and those sorts of things. But it's kind of priced into the market now, and what essentially has happened is there's less rental properties available, so you see more competition for those rentals, which puts upward prices on rents, which I think policymakers aren't necessarily trying to do, but it's a consequence of the changes they're doing. With listings, new listings have increased just over 15%, and total listings up 18% since last year. So that just means that there's more opportunity to get in and get something with less competition. When it's a hot market, prices get nudged up weekend after weekend, and then we sort of have to wait for the data to catch up. I think there's tremendous opportunity in the state of Victoria, and contrasting that to places like Adelaide, Brisbane, Perth. These markets, who knows, they could run for another 12 or 24 months, but they can't run forever. And Dave sort of talked about when we should be making moves. People tend to make decisions when they see volatility in shares and they get a little bit scared. But ideally, you want to be jumping in when it's a little bit on the nose, because you get 100% of that upside. So I'm sorry to say that Melbourne's on the nose to Melburnians, but the upside is there. I think there'll be tremendous opportunities for people.
Do you know what I note out of the data that you've just been citing, Mike? It's the sheer number of listings that we've got now, and compared to all of the other capital cities, except for Hobart and Darwin, Melbourne's leading the pack on new listings. But when it comes to total listings, we're in front of everyone, Melbourne and Victoria. And I think given that volume of available listings and the fact that we haven't been decimated with our capital growth, it says a lot about our city's resilience, because we've got a lot of negative headwinds.
That's a really good point. Like you could reasonably look at those listing figures and expect that, well, there's probably been a 5 or 6% drop over the last 12 months. I mean, that would be completely reasonable. And then it begs the question, okay, if we're in this kind of situation with listings that should point to a terrible property market, and we're sort of sitting flat, imagine when those get tight, and now's an opportunity to get some of those quality assets that are going to be really hotly contested when that turns around.
Yeah, that's a great point, Mike. It's just been, a tough couple of years all around for Melbourne. And when we talk to the agents, they're reporting that a lot of their sales are investors bailing out. And the interesting thing will be yet to be seen. Once those investors who have made the decision to exit have exited, then what happens to our stock levels and what happens to our capital growth? Dave, Emma's also mentioned that she's expecting to sell a property and have some more available capital to make a decision in the not too distant future. And so whether we're crystallising a gain or whether we're getting an inheritance, how should this kind of bonus influence people's investment decisions?
Well, yeah, look, I think if you're getting some sort of bonus down the track from such as an inheritance or similar, I particularly an inheritance, I would say not to plan for it. There's a fair bit of evidence now to show that people who plan for inheritances tend to not budget and invest as well during their lifetimes compared to others. And this idea is supported in a book which I've read that I would recommend to our listeners, called The Millionaire Next Door: The Surprising Secrets of America's Wealthy. And so some of the key points to consider, particularly when it comes to an inheritance, is to avoid counting on it. So many things can happen that might reduce or eliminate the expected inheritance. So that might be unexpected medical bills or changes in the benefactor's plans. And it's crucial to focus on building your own wealth independently. So as I touched on, it can impact, or the research suggests it can impact on people's diligence with budgeting and investing if they are essentially planning for an inheritance down the track, and that can lead to complacency. So just striving for financial independence, regardless of potential inheritances, ensures that your financial stability does not rely on factors outside of your control, and then ultimately, treating it as a windfall when that comes, to enhance your financial position, and just making the right decision or decisions with that money when you receive it. It would be my advice. I'd also certainly recommend consulting financial advisors. If you're looking to invest in property, experts in that field, whether it's a buyer's agent, property planner, strategic mortgage broker, quantity surveyor. So making sure you're getting the right advice around your investment strategies, how to maximize the benefit of the inheritance, debt reduction, tax implications. And so look, that would be my advice when it comes to the potential to get an inheritance down the track.
I love it. Yeah, it's a great overview. I think we could do a really good episode on inheritances and, get some of these insights from people in the know and bolster up some great facts and figures for our listeners. Now, we've reached the end of our show, so it is time for gold nuggets. Have you both got your thinking caps on?
Now it's time for us to go mining for our gold nugget property tip of the day.
What I love about this listener question is that they are young and they've reached out with a question. So they're thinking proactively about investing. They've got lots of time in front of them. And I've always said time is your best friend in this game. So I'd love to hear how they go, what sort of action they take, and what projections they've got in front of them, and stay in touch with us on your journey. We've really loved this question.
Look, what jumps out at me for Emma and her husband is they've been investing from a young age. So it sounds like Emma's husband got into property and made property investment decisions and was quite considered. He's purchased interstate with his investments, and Emma's clearly had a preference for shares and invested in shares. I would just highly encourage that to all our listeners. It's never too soon to start investing. Be proactive. They've probably been proactive in their careers as well because they're both on a high combined income, and that's put them in the position that they've got to. So, that diligence, proactive, hard work, be investing, and that's how you set yourself up over the long run. You've got to be in the game. So, yeah, well, that's my gold nugget.
I think, she sort of said her default thinking is 100% share investing. And, she could definitely just stick with that. You could do it that way. You got great incomes, in a great position, you got plenty of time. But, I would argue if maximizing the return over whatever time horizon you decide to invest in, the power of leverage is going to outperform shares. Shares might do better over the next 10 years from a growth perspective than property, but you add in the leverage and then it's kind of like property's cheating a little bit. You don't have to go either way, but I think the opportunities in property are great right now. So that was the end question. My timing is, now or wait. If it's about the market, I think the best time to invest was yesterday. And I think waiting in a market like Melbourne, you could pay for that decision. If it's all around, timing for them personally and their financial situation, of course, that's a consideration, but they are in a strong position. And my last one was, the comment saying we own an inner city apartment rented out for $900 a week and we'll sell it when the kids are out of childcare. I would not lock in a decision like that. I would wait till the point where they're out of childcare and assess it on merit. I think we can do ourselves a disservice when we commit to an idea, but things could have changed by then. That could be an asset that has growth potential. It could be a cash flow asset that enables you to leverage better. So don't just lock into that decision. Think about it when it comes to the time and run the numbers and make what's going to be the best for you.
Really
that's
nicely
a great
done.
little point to pick up on.
This has been a great one. I'm glad you picked it for your topic, Dave, because we do have a good database of juicy questions that we'll be chipping through. So thanks again, Emma.
Yeah, thanks, Emma. Great question.
Yeah,
Well,
best of luck. Like you said, Cate, I'd love to hear what she decides and how they go, and check in 10 years if we're all still alive.
Yeah.
Send us an email once a year if you can.
Well, on that note, you guys have a great week. Mike, I will see you in sunny Sydney on the weekend for our REBA conference. And I look forward to catching you fellas same time next week.
Sounds good.
Enjoy the conference. See you guys.
Thanks, Dave.